Golden highs and Trump trade shambles, tax-free and ETPs, MPC cuts, two-pot lower than expected, local vehicle sales. This is JC Direct, episode 617 for 6 February, recorded just ahead of the market open. My name is Simon Brown. This podcast is brought to you by Standard Online Share Trading and Shift Global. Shift for your FX transactions, buy, sell offshore shares and ETFs. So that we said we were going to be having a name change. That hasn't happened. We've got a delay, but we will be doing that. We've got the sponsor coming through with Standard Online Share Trading and Shift Global. We'll be doing lots around that over the course of the next many months. And we will be doing the branding. We're going to change to Simon Shares. Suppose we can tell you that. It's still today as JC Direct. That change will happen. Bunch of reasons. I'll go into it next week when we've got all that branding. Hopefully we do have all that branding. So let's start, I suppose, with the Trump tariffs. They were announced our time late Friday evening, or early evening, I suppose, but our market was closed. It was China, 10%. It was Canada and Mexico, 25%. And it was going to take effect on Tuesday. There was, of course, all shades over the weekend. Negotiations Monday, the markets were absolutely rattled. And then we got the news coming through that they had done a deal, or Trump had done a deal with Mexico, and that he had eventually also done a deal with Canada. Neither of those tariffs went into effect. They will come in 30 days unless. Now, what we learned were a couple of things. This was no art of the deal. I mean, what Canada essentially gave America was some choppers, a drug czar, and a plan that had actually been proposed or put in place the previous, in fact, 2 months ago, back in mid-December by Biden and Trudeau. So Trump got nothing, although I suppose he kind of got, in a way, his bully pulpit. But there's a bigger thing that's going down here. And I'm going to come to China because that's a whole different story. Canada is, without a doubt, America's best and biggest ally. Make no mistake about that. And Trump has essentially shattered that. A quote from Buffett, Warren Buffett: "We can afford to lose money, even a lot of money, but we can't afford to lose reputation, even a shred of reputation." And that's what's happened with America now, is that, frankly, no one trusts the American, or not, the trust in America and President Trump has gone down markedly from their closest ally, Canada. Now, what that means in essence is that negotiators are going to be like, what does this mean? It means that negotiators are going to look for plan Bs. Now, let's be clear. America's the biggest economy. If America wants to sit at a negotiating table with you, you're going to sit there, Trump or no Trump, because that's the best deal. But you're also going to wonder in the back of your mind, is this thing for real? Is it really going to happen? And time will eventually tell. It also makes no mistake, it makes the likes of China, Russia, Europe sort of look up and say, hang on, there's perhaps a space here. You know, that negotiating table which America was at, well, maybe we can sit at that table instead. It is shaking up world orders. Rikus Reeders from PSG Hole-in-One Ramsich was on Stockwatch with me on Monday evening. And he said there is a change happening. And it started probably around the financial crisis of 08, 09, and it is tearing down the old institutions, the Bretton Woods, the World Health Organization, the World Trade Organization, United Nations, etc., etc. The trick is that as a society, as a planet, as Earth, we don't yet have the new institutions in place that will take their space. And that is why we find ourselves in incredibly volatile times. China and the Trump tariffs. So if you remember, and I've said this more than a few times on this podcast, Trump did tariffs on China back in his first term. Biden increased them, absolutely did. For example, they struggled to get hold of chips from NVIDIA. They can't technically get the H100s. They got to get H20s, H80s, which are not as powerful. Now, they get some H100s, make no mistake about that, but not as many and not as easily. So the 10% on China. China didn't come back and shout and complain. They just quietly put some more tariffs on rare earth metals. They'd actually put tariffs on the two more popular rare earth metals. I think was it January, perhaps it was December, I forget exactly when. But the China-US trade tensions, and I say tensions because it's kind of happening under the surface rather than wars, which is what we saw with Canada and Mexico. Those Chinese trade tensions continue and will continue. Absolutely, they will. The whole TikTok story, we don't know what's going to happen with that, but those are definitely there. They are real. They're not going away anytime soon, is my sense. So, as investors, how do we manage this? Well, expect volatility. Expect lots of volatility. Don't panic. Just, if you had panicked on Monday and jumped out of positions, you would be feeling very aggrieved sitting here later in the week because, you thought you were getting out on what made sense and then, well, it just somehow didn't happen. And now you're feeling very, very, very foolish. So careful of panicking. And Chantal Marx from F&B Wealth and Investments made the point, maybe keep a bit of powder dry, a little bit of extra cash because there might be some opportunities. I asked Petri Redenhuis if we should buy the dip, and he was like, be careful and stay close to the door. Now, Petri's more of a trader. Chantal is more of a long-term investor. And that long-term point is where I want to finish with. Remember, we are long-term investors. We are thinking in decades. Trump is only here for 4 years. Now, he's gone in January, 2029, there will be a new president. They may be worse, they may be better, we don't know, but your portfolio is going to, all things equal, outlive a Trump presidency. We're back with Power Hours. I need to click that button there. So first Power Hour is kicking off this month, 18th of February. The day before the budget. We're looking at exchange-traded products and tax-efficient investing. Exchange-traded products is ETFs, actively managed certificates. It's much wider these days than just the ETFs. We do the February one always with the sense around ahead of budget and the new tax year for individuals, which kicks off on 1 March. Will we get increases to our tax-free savings accounts in terms of the annual limit? The lifetime limit is moot. We're not yet approaching that, but will we see some changes there? We will go into details around the different ETPs, around tax efficient, which is definitely tax-free investing, but there's more than just tax-free investing in terms of how we can be efficient. JustOneLab.com/events for booking and more information. You can, of course, attend the webcast, but we're also going to be at Baker Street, Standard Bank head office in Rosebank. We're back in the larger venue in the main building. So come along if you're in the greater Johannesburg area. Great to see you. So we had interest rate decisions last week. Later today, the Bank of England is making a decision. It is expected that they will drop 0.25% to 4.25%. Last week, Jerome Powell paused, and that wasn't totally unexpected. The U.S. inflation has been ticking a little higher back to sort of that 3% level, and massive uncertainty in terms of tariffs and Trump presidency and all of that. So Jerome Powell pausing made sense. Our own MPC did cut. We got another 0.25% cut. That puts the prime rate at 11% locally. It is still a massively high number. It still puts our real rate of interest rate at around 8%, which Dr. Roelof Botha says is the highest in the world. Under Jill Marcus, that real rate interest rate was closer to 3%, which would suggest a prime at 6%. I can't see that ever happening. But anyway, the point being is we got the cut. Pretty much the consensus is we are locked in for at least one more, and a couple of institutions and economists are saying we will get 2 more by the end of the year, taking us to 10.5%, and then our own MPC will pause. Of course, these are wild times, these are volatile times, that can certainly change. But what we are seeing as a result of all of this is gold, and gold is having its day in the sun. Make no bones about that. I have been talking about gold a lot more than I would usually have. So I just got to type in the code there, and then let's share that. Gold is trading just below the 2,900 level. I want the chart. There we go. Thank you very much. And let's zoom. So a nice little breakout that's happened. Some nice weekly candles. I want to switch this to monthly because monthly looks quite pretty as well. That January candle was nice and bullish. A nice breakout coming through there. So gold is looking really, really good. Make no bones about it. And, the question everyone's saying is, well, how much higher? I don't know. But the story for gold remains. I chatted with John Reed from the World Gold Council on my Money Web show. Was it Wednesday? Yes, it was. And a couple of things. Firstly, production is maybe at a record, back at 2018 levels, but only up 1%. We're not seeing massive production come online. There are very few greenfields projects around the world. I've spoken before how it took Goldfields, was it 13 years to get their Chile production from discovery to production. There is some stuff. Harmony's got some greenfields, but there's not a heck of a lot coming into the market. On the flip side, demand remains there. Central bankers bought another 1,000 tons out of about a total 5,000 tons for the year. That was another plus 1,000 for the central bankers and accelerated in the fourth quarter with 333 tons bought in the last quarter. We're seeing tech pick up some, but it's about 6.5% of demand. It's not massive. And of course, tech is always trying to find ways to push costs down. So, Apple, Samsung, the cell phone makers, and everybody else is trying to find ways to use less gold if they possibly can. And then beyond that, of course, we've got, interestingly, retail ETFs. Now, retail ETFs had seen outflows for 3 years up until the middle of last year. The last 6 months of last year, we saw inflows into retail ETFs. That's mostly Western investors in places like Asia and the like. A lot of the gold is physical coins, bars, etc. that are being purchased. So gold remains strong. Gold remains looking positive and looking like it's going higher. As I said, where's it going? I don't know. 3,000, certainly on the cards. Thereafter, we'll find out in time, I guess. Question is gold or gold miners? I got a bit of both. If you want a gold share, a miner, a pan, maybe. I mean, look, Harmony's done spectacular. So maybe Harmony's maybe overdone it to a degree. You want to pick up a Lager, Anglo Gold Ashanti, a pan. But they all going to make better money as gold moves higher. So there certainly remains a bullish story in that regard. We had Pick and Pay and Boxer numbers coming through, trading updates. The updates that they've been coming have been not bad. The market, however, has been selling off those updates. I'm thinking, the Truers update was a horror, 1% growth in Africa. Come on. And that's not even inflation. That's negative. Mr. Price, Clicks, PEP, all of those numbers, Fashini Group, looking not bad. But what we're seeing is the market is taking a jaundiced eye view and saying, we expected better. They liked ShopRite. It was, as always, good. The Pick and Pay number was a tough number, but you're seeing those early signs of a turnaround. And credit to Sean Summers. What's he been there 14 months, and we're already seeing some signs of the turnaround. Boxer, pretty much in line with what we expected. Two-pot money. So we got a lot of data in the early part of the two-pot money, and then it kind of faded away, and we didn't get much more. So SARS has given us latest numbers. It's only about 50 billion. The expectations were somewhere between 40 and 80. But what we saw was we hit 30 billion in like the first, I think it was 5 or 6 weeks. And my sense was, we're going to get to that 80 in double quick time. But no, we're at around 50, which means 50 billion is a big number relative to our economy. Fairly small and lower than I had expected. So 50 billion pumped in, nice. What we also got now is that ongoing. Remember here you could take 10% or 30,000, whichever was smaller. Going forward, as you put money in, you can take out 30% of it or a third of it. So we will have a sort of a continual folks coming along and saying for, maybe emergency reasons, maybe holidays, maybe debt, who knows, folks are going to come along and be taking money out. So that's now going to be, in a sense, a permanent component of the South African economy, where we just constantly keep on seeing the two-pot money being utilized and coming through. I want to look at Total vehicle sales for South Africa. We had those out. It was early this week. In fact, we got some January numbers. January is typically not the best month. You know, it's January. We're sort of getting over the December. We also, frankly, don't have money because we spent it all in December. I think zoom out a bit more. But that January number wasn't bad. I mean, if we look at it here, 46,400. The only higher numbers have been, November and October, which makes sense, two-pot money coming through. And then we got to go back to that June 23 and ultimately March 23 for bigger numbers. I was surprised by the strength of those vehicle sale numbers. They are, you know, we're not massive. And let's zoom out 20 years and you can see, you know, we were targeting much more. 20 years ago, we were getting up to 65,000. There was talk we would get our industry to 1 million vehicles a year. That's 80,000 a month. That just seemed a heck of a lot. That talk has long gone. Point being is folks are buying vehicles slowly, cautiously. The used car vehicle market is bigger than it used to be, and the ratio between new and used, more used than ever before. That's unlikely to change. The Chinese brands obviously having a good time of it. It's a sector I like. I have CMH. There are other options. There is Zeda. There is Motus. So vehicle sales, I thought nice. I thought those were a decent number that we can absolutely grab and be, I suppose, happy with. Sasol, they came out with a 6-month trading update. I mean, numbers are falling left, right, and center. I suppose the big one that really matters is the HEPS. It's going to be 13 to 15 rand HEPS. Now, so they are again they are writing down assets. Sorry, lost my train of thought there a second. They are writing down assets again. This is not new from Sasol, and they are struggling. Jimmy Moyaha said it on my show this morning. They have their own unique set of problems, and they have lots of them. But let's say 14 rand, right? So for the half year. So let's say 28 rand for the year. That's 87 rand share, 28 rand. That's a PE of a little over 3, which is truthfully pricing it for bankruptcy, right? Absolutely it is. Is Sasol going bankrupt? I can't believe it. It provides a third of the fuel in the South African economy. But I'll say it again, and I've said it before, I need positive signs of a turnaround here. I need to see something happening on the chart that says to me things are changing. And at this point in time, the best I can do is a little bit of a line there and say, well, maybe it's slightly less worse. I continue to watch Sasol. It, to my mind, is not quite yet time to be owning Sasol. That day will come, maybe, but it is not right now. JSE is a registered trademark of the JSE Limited. JSE Direct is an independent broadcast and is not endorsed or affiliated with, nor has it been authorized or otherwise approved by JSE Limited. The views expressed in this program are solely those of the presenter and do not necessarily reflect the views of JSE Limited. That's, as always, the disclaimer. We'll leave it there for today. My name is Simon. We are planning to release this on Wednesdays. I had challenges this week, which meant we're out on Thursdays. We'll try to get to Wednesday tomorrow. As always, look after yourself, and if you can, look after somebody else as well. Cheers all.